Yeah, we'll know in a couple of days what the Fed says, but QT is here. Arguably, interest rates are still headed higher in the West. How is that does that put a lid in the near term, and is the market failing to recognize that? Or is there something else out here? Because despite the Fed sounding hawkish, it's not that markets have really buckled down too much. Why is that happening?
Okay, so that answer is a more macro global answer, Neeraj, because everywhere equity investors are of the belief that the Fed tightness is temporary. Right. So if you look at expectations, people are talking about the Fed funds rates crossing 4 point some% by March or June next year. But thereafter, the market is pricing in rate cuts. Okay. Or let me to put it another way. The Fed is trying to break something by tightening liquidity and raising rates. And the market recognizes that the Fed will tighten until something breaks. But the moment something breaks, the Fed will come back and give me more money and be supportive. So the market's already looking through the failure of liquidity and starting to look through to the fact that the Fed will eventually become supportive. The risk, of course, is that presumption proves incorrect and that the Fed remains tighter for a variety of reasons that could happen. The Fed remains tighter for longer, and equity markets, should it come to the realization that, hey, the Fed is not going to swing in June and turn dovish, then equity prices everywhere globally have downside.
Is that what you would believe would be your base case?
Yes. As things stand today, and like I said, there are 2 or 3 big event risks that need to be sorted first. Neeraj, this war in Eastern Europe needs to be contained and, of course, needs to be solved for all our sakes as quickly as possible. If that does not come through and the conflict continues, let's say, to the mid of next year, then we'll all have to review our global economic views, all have to review our global monetary policy views, and so on. That's something that nobody can predict, right? There's no way you can model the geopolitical situation. Of course, the recession that Europe will go through will have an impact on earnings and numbers. And we are kind of worried that even the US may feel some impact of on growth, and you might actually start to see earnings cuts. So again, there's a little bit of uncertainty. If I may jump in here on how this matters to India, Neeraj,
please,
is that so far the RBI has expended reserves to defend local rates in a way, to defend the currency, and it's the right thing to do, possibly because these are event risks. You do not know how long they'll last. But the fear is that if this uncertainty, like I said, continues into next year, even the RBI may be required to review its position, because India's balance of payments still remains negative. Our exports are weakish at the moment. Yes, oil prices are down, but the trade deficit isn't. The current account deficit isn't down yet. So if at some point the RBI realizes that it cannot continue to expend reserves, then you will see a tightness in Indian liquidity as well. And Indian rates will also have to rise faster in order to then start reflecting the global macro. So that's the risk to us if this uncertainty continues into, let's say, middle of next year.